So let me start off with really the big question I think everyone is asking, which is also actually our question of the day. Have financial markets at this point fully priced in the impact of the war? And what does the inflation print tell you, given that there's a real possibility that further inflation readings are actually going to be even hotter than what we've seen?
Hi, Heidi. Well, certainly, I think the biggest and the biggest shock of this war is pretty much priced in. But I think the second order or even the third order effects, I think there's still room for markets to find an equilibrium, which looks like a not so great scenario, as you pointed out. We still haven't seen the effects of the price rise in almost all the entire commodities complex. You would imagine next month CPI print would be likely to be higher than whatnot.
So how are you trading at the moment? Are you sort of preferring to sit on a bigger buffer of cash, or are you being very selective?
You're right. I mean, over the last 4 or 5 weeks, we've been reducing risk quite aggressively in our balanced portfolios, and now sitting pretty much in very high level of cash. Now, as I mentioned, I think we've seen the biggest shock. Then we'll probably have to watch out how the second order effects play out. Although we're monitoring the situation, there are a few areas globally that have become a little bit more attractive, and we'll be waiting to redeploy our cash as and when we see a good opportunity, something like a further talks on ceasefire.
How attractive is China, given that their inflationary pressures have been muted as compared to the rest of the world, but at the same time you have all of these regulatory issues? For example, in the New York session, we had Chinese ADR seeing the worst day since 2008.
Indeed. For now, because they have price moving mechanism there, so a bit of the price shock they could absorb until a certain point. But beyond that, it's anybody's guess. Now, we always think investing in China it takes out a bit of a patience. So we were loading not aggressively, but we do have positions there. Now. Don't forget that this common prosperity is such a critical guidepost. So regulatory gestures, here and there, are unlikely to go away anytime soon. But the Chinese market still compares well in terms of valuations. But the catalyst for improved performance of the market really depends on earnings outlook and further monetary or fiscal stimulus, as we would expect after the NPC meeting.
So what's your base case for that, given that it's such a politically important year for China? Can we expect that support to be forthcoming?
Indeed. We've seen monetary easings here and there. So everybody's looking forward to a bigger fiscal stimulus sometime this year. I think the NPC meeting doesn't set a target to be disappointed, so they will have to do something to mitigate the external shock coming up from Ukraine.
I think back at the start of the year, you were pretty bullish when it comes to energy as a diversifier in a portfolio. Is that still your position?
Indeed, we like energy. Not predicting what's happening over in Europe, but energy stocks in general are trading reasonably well. They're starting to give good dividends, and of course now with the windfall of rising prices, we continue to like energies. But note that energy stocks don't always trade very closely in correlation with the underlying oil prices. So and also be aware that again we've seen the biggest shock. It could swing a bit up or down going in the near term. So we want to be very selective into this area.